This is the way it has been presented. But I'll give you two examples. Okay, I deal with both Infosys and Wipro, and the IND-AS numbers that are reported by these companies are exactly the same as the IFRS numbers, 100%, no difference at all. Okay, and therefore, when we talk about carve-outs, which you will hear over time with different speakers, just keep one thing in mind. There are three types of carve-outs. Okay, no book will tell you this. There are three types of carve-outs. There is one which I call the optional carve-outs. So, for example, if you take fixed assets, or as you will now hear, people call it property, plant and equipment, but it is still a fixed asset. Don't get too worried. It is still a fixed asset. If you look at fixed assets or property, plant and equipment, when the companies moved to IND-AS, they had three choices. Okay, one was to go back and recast all of the balances and say, if we had always followed IND-AS, what would it look like? Okay, first option. Second option was to say that can I do a revaluation of all my property, plant and equipment, and if I do that, what's the fair value today? And I will use that as a starting point, because who bothers, why should I bother about going back and restating everything? Or third, for the laziest lot, which is 98% of us, including myself, you say, why bother with any of this? Let's take whatever we had done for Indian GAAP as of 31st March 2015 and use that as a starting point. Let's do this prospectively. Prospectively is the flavor of the day as well. Everybody likes prospective stuff. Now, if you choose option 1 and option 2, okay, you are fully compliant with global IFRS. If you choose option 3, you are not compliant with global IFRS. So that's the carve-out. It's in your hand. It's an optional carve-out. Which means if a company wanted to be fully compliant, it would make a choice which would align it to global IFRS. But if a company didn't care and said, look, I don't care about global IFRS, not relevant for me, then you have created a difference. That's what I call an optional carve-out. The second carve-out is, in many areas, IFRS gave you choices. So for example, let's say there is a company and that company has a property which it does not use for its manufacturing or does not use itself, but they rented it out to somebody else, right? Globally, under IFRS, these are called investment property. You will hear about it in the course of the day. And you have two choices. Either you can treat this investment property as any other item of fixed asset and carry it at cost, just like you do any fixed asset. Or you say, you know what, because I am not using it, I am interested in the capital appreciation in this property, right? And therefore, I carry it at fair value, and changes in fair value, I will take it to my profits. Okay? Global IFRS gives you two choices. Indian IFRS or IND-AS removes the fair value choice. Okay? But that's fine, because even if you are at cost, you are still compliant with global IFRS. Isn't it? So the point is, even though some people may call it a carve-out and put it in their list of 30 carve-outs, it doesn't matter, because we are still compliant with global IFRS. And then there are very few carve-outs, 3 or 4 at best, where you don't have a choice. There is a conflict between IND-AS and global IFRS. And those are the only ones which in my mind, which I call mandatory carve-outs, are the ones where companies need to be bothered for compliance with global and India. They affect a handful of companies. They are not generic in nature. The reason I gave you a very elongated description of this is to reassure you that if companies do the transition in the right way, you can be compliant both with IND-AS and with global IFRS at the same time, and many companies have indeed done that. So I think that's good. The other point which I think is good is many steps have been taken to deal with the corporate law issues. So as we know, the Companies Act was amended to facilitate a lot of this, whether it's for depreciation or many other items. There was a lot of concern around taxation. We love taxation in this country. Everything kind of ends with taxation, which I think is good. And a lot of people said, you know what, this IND-AS, IFRS is all based on fair value. Okay. By the way, that's a misconception, which hopefully after 6 days you will know that the eureka moment, that all this fair value is nonsense. But what will happen, what indeed is, there is a lot of unrealized items that will be recorded in the P&L. For example, let's take a simple example like derivatives. Okay. Did I say simple item like derivative? My God, people are looking at me saying what's wrong with this guy. Okay, but that's the way I operate. So if you had derivatives, and let's say in today, if you have a mark-to-market loss, we record the loss under Indian GAAP, but if it's a gain, we don't recognize the gain. The concern was, under IND-AS, of course, you recognize both the gain and the loss. if you recognize the gain which is unrealized, then you have to pay taxes on that gain. So there was a lot of apprehension around that, and that's when the government set up the committee called the Income Computation Disclosure Standard Committee. I'm actually on that committee. I'm trying to get out, but I don't know how. Okay, this is all being recorded. Shit. I've been on this committee for 6 years. So 6 years, a lot of real good work, hard work has happened out there. And I think at least on the direct tax area, there is clarity now to say that look, it doesn't matter whether you are a company which is on IND-AS or whether you are a company which continues on old Indian GAAP, your tax liability is not going to change except MAT. Okay, and MAT I will touch upon later on a little bit. So I think these are good steps that the government has taken. The other thing which I like is SEBI has been very responsive. So whenever there has been a concern from industry to say, so initially the proposal was that when the June 2016 quarter is presented, June 15 also has to be presented on a comparative basis and also has to be reviewed, but people realized they were not ready for that. So SEBI said, look, let's not procrastinate this anymore. Go ahead and publish your June 16. If you're not able to show June 15, no problem. They gave a 2-quarter relaxation for the June and the September quarter. Similarly, some companies said we are ready because we want to tell investors what the comparative looks like, but we're not ready to get it reviewed by an auditor. They said, no problem, we'll give you a break. I think this is a very good practical way. Rather than keeping on deferring everything forever, I think what they've said is go ahead, do what you can, and the system will catch up over time. I think that's a very good approach that SEBI has taken. And the Institute is doing a very good job setting up what is called the ITFG. It is the IFRS Transition Interpretation Committee. Very good representation from both industry and profession. They've been coming up with some very good deliberations out there. And the Institute also has been very proactive in issuing FAQs. So for example, if, some of you may remember, I have a question. How many of you are from companies and how many of you are practitioners? I mean companies, how many from companies? Okay, all the front benches are companies, is it? No, okay, that's just a coincidence, sorry. And the rest are practitioners, I'm assuming. There was a lot of debate, for example, on excise duty and how excise duty should be classified in the P&L. So for example, today we show excise duty in a particular manner. Going forward, IND-AS will require us to show it in a different manner. But SEBI actually had not changed its own format. The Institute very quickly came up with a clarification to say how that particular situation should be dealt with. I think that's very good. The reason I'm highlighting this is to say that ICAI is being very proactive to understand there will be problems and how those problems need to be dealt with. I think that's the positive. So overall, there are benefits. I think there is the transition smoothening has already started, and I feel good about it. But there are challenges. Like with everything, there are challenges. Otherwise, you would not be sitting here debating this topic. The first challenge really is the finance functions in companies are not geared to meet this change. Most big companies, while they've done a lot of preparation efforts, are still thinking through how do you embed this into your systems. So people have taken help, a lot of consultants have helped them, but consultants cannot run your finance function. You have to run your finance function. I think that embedding is becoming more and more important. What that also requires is to make sure that everything around that, this is not just about the trial balance and the general ledger. This is also about your IT system, because you cannot keep on doing this manually. Your IT system, your ERP was geared to capture information to support reporting under the old accounting standards. There are new accounting and disclosure requirements now, and therefore you would need to do it differently. So I think there is a change there. And one important point, and I'll tell you this really funny story. This happened when Europe moved to transition. It's a very big telecom company who I will not name. So there was this analyst call where the CEO kept on talking about how profits had gone up. This was in the year of transition to IFRS, which some of you may remember was 2005. And he kept on talking about how profits had gone up. But in the reported numbers, the profits had actually come down. Okay, that guy was looking at old UK GAAP numbers, and the market was looking at the new IFRS numbers, because that's what we shared with the market. So they got to a stage where this guy had a very upbeat kind of view on the company, and then he came and he said, by the way, but somebody pointed out to him, but your numbers have actually fallen. Oh, he said, that my CFO will explain. Okay? So there was a complete disconnect between the business, budgeting, how business was looking at it and how finance was looking at it. I think that is the journey we are at right now as well. A less starker example maybe, but I think we should be very mindful about that. I talked about senior management, this is an example. I think equity analysts are completely confused. Okay, I won't take names here, but I will tell you, a very large infrastructure company had a lot of joint ventures, and they used to report revenues, consolidated revenues. So under the old regime, as we know, joint ventures were done on a proportionate consolidation basis. Under IND-AS, there is no proportionate consolidation. Okay, so the top line goes away. You just pick up your share of profit in the joint venture as if it was an associate company. Profits remain the same, but top line changes. Now, as you know, in the infrastructure sector, and the EPC sector, there is a lot of focus on what's your order backlog, what's your revenue growth, and the analyst community completely misread this. So the company presented its current period numbers on IND-AS, which did not have the JV revenue. First, they did not present the past period IND-AS number because they had the relaxation. And they told the market that look, if our current period was done on the basis of old Indian GAAP, here is what our revenues would be. Okay? But like I said, 98% of people are inherently a bit lazy. So what the analysts did, and I spoke to a lot of analysts who called me after that, they put the current period numbers, okay, based on IND-AS. They said, why bother about the past period? वो तो हमारा Excel sheets में already पड़ा हुआ है, right? But they were Indian GAAP numbers, and revenue showed a huge drop because of this proportionate consolidation issue. So the equity analyst in the community is completely confused right now, and there's a lot of education that's required at that end as well. The other people who are very confused, who generally are confused but are more confused now, are lenders. You know, so the one concept that you will hear on day 2, day 3, whenever, is the concept of embedded lease, okay, or a service concession agreement. Now I won't bore you with the details, but I'll give you a very simple example. So let's say there is a power company which has a power plant, and that power company has entered into a power purchase agreement with a state electricity board to supply power for 30 years. And that is the only customer, one SEB. Now normally the way these power purchase agreements are structured is it is structured to give a particular return on capital employed to the power company. That is the way it is basically structured. Okay? Whether the customer consumes power or not, they pay for it. Under IND-AS, it is accounted for as if the state electricity board has taken the asset on finance lease from the power company. Okay? Which means the whole power plant goes away from the books of the power company. Forget the books of the SEB, nobody has ever seen them. Okay? But at least at the power company, the asset goes away and gets replaced by a finance receivable. Now imagine the lender who has lent money against that power plant. Okay? That guy will fall because he is seeing where is my fixed asset coverage. There is no fixed asset, forget coverage. So the lender community is in a bind right now where they have no clue on how to read some of this. Again, I am highlighting this so that you should be mindful of this when you are, the 6-day theory cannot be in isolation of what is happening in the world. So please be mindful about this. I talked about some of this stuff on MAT. Just an update to the group. Our committee continues to labor on to define what will be the effect of IND-AS on MAT. Because MAT, as we know, is a book profit concept. There are two arguments. One argument says that look, if a company is on IND-AS and therefore its profits are affected by IND-AS, MAT is calculated on that basis. But a company which is not on IND-AS should basically go by what their book profit is. Now, is this equitable? Maybe it's not, right? But what are your options? Either you get a company which is on IND-AS to recast its books under Indian GAAP again for parity and pay MAT on that, in which case this half of the group will complain, okay? Or you do it the way I said, follow it in which this half will complain. So there are no winners out here. This is going to be a call which our committee will have to take, which the ministry will have to take. We are in discussion with the Ministry of Corporate Affairs because one of the things we've said is that this has to be linked to distributable profits. So if you let companies distribute profits based on IND-AS, then that becomes the basis for MAT. if you say there are going to be certain adjustments to distributable profit, because some unrealized profits are not allowed to be distributed, then that's fine. Those items can be excluded from MAT as well, but there cannot be a delinking between distributable profits and MAT. So that's the concept we are working through, but that's an open item that you guys should watch out for. I talked about this, practical implementation experience is not there. The good thing is this experience is not there even with your auditors. Okay, so for those of you who are in the corporate world, even your auditors, you know, when I started doing this 20 years ago or 22 years ago, just why you remember, I had a secretary who was a very intelligent man, and he once told me, he said, I figured out what is the difference between the KPMG team and the client team. And I said, you know, tell me, Umesh, what is the difference? He said, you have the books. Okay? So that was the only difference. We were reading the same books and trying to tell the client in terms of what had to be done. And we are in a similar state right now. Everybody is reading the same book. As the point was made rightfully by Rahul, people who read and apply the book first, okay, will be the trendsetters in terms of determining what is the future of IND-AS in this country. So please realize that. Okay, now having said all of this, IND-AS itself is not static. So we just had a change, but remember global IFRS itself is changing. You have the new revenue recognition standard that will kick in from 2019. So we have to be mindful about that. Just when we are getting used to this, there will be another round of change. On leases, there are some big standards kind of changes. What is called IFRS 16 globally will come in. But the short point really is the journey has started. From here on, it will be a journey. I'm conscious of time, and I'm going to leave some time for questions and answers. So I'm going to speak for another 5 minutes and then sort of open it up for maybe questions before we close the session. I think one is companies are spending a lot of time rightfully on what do you do on transition. So I go back to that same example I started off with, right? Which is if you take fixed assets or property, if you decide to do fair value, for example, and let's say fair value is higher, okay? You may have a better net worth on day one, but you will have a higher depreciation charge in the future, right? And conversely. So companies are looking at transition choices very, very closely. I don't know how many of you have seen the way Reliance Industries has transitioned, but I would actually recommend very strongly as a case study. You go back and read that. Nothing wrong with it actually. I think it's been very well managed. But there are many other companies who I know who are in a similar position but have used a different transition choice. So I think it's an interesting area. I talked about this. Okay, now some of this will require a change to contracts, and I'll give you an example. So let's say if you or your client is a company, and let's say they have a subsidiary company in which they own 51% and 49% is held by a foreign partner. In the past, we treated that as a subsidiary because we have a majority ownership. Under IND-AS, as you will learn, that's not enough. You have to demonstrate control. Now, most of these agreements provide the foreign partner the right to block key decisions, whether it is appointment of key managerial personnel like the CEO and CFO or approval of budgets cannot be passed until the 49% foreign partner or Indian partner, whatever, has also agreed to it. Now let's say this consolidation is very important for the Indian company which may be listed. Okay. Now it will not change overnight. If you were to go and change this agreement, it will take a lot of discussions, negotiations via media with the partner. So companies are prioritizing and have to prioritize to say which of the changes are fait accompli, where all you need to do is kind of capture it, and which of them are things where you basically need to go back and look at some of the contracts. I have 5 minutes more, right? Yeah, thank you. We talked about this, debt governance we spoke about, analyst community I spoke about, budgets we spoke about, IT systems, and training and skill sets is another important area. So what is the initial analysis? So 1 quarter has gone and companies have reported. We actually surveyed 75 odd companies where credible information is available on companies that had moved to IND-AS. And these are some thoughts that came out of that research my guys did. One, proportionate consolidation, which I spoke about, which is whether it is the example of that infrastructure company's top line going away, or something which was otherwise a subsidiary or a joint venture no longer being consolidated. So I think there is impact on that coming in. Fair value of investments. Now remember, fair investments could include something as simple as mutual fund investments. So today, if a company holds a fixed maturity plan mutual fund investment, it carries it at cost. Only in the period in which the FMP matures, you recognize the gain. Okay? But going forward, every period and every quarter, it is recorded at net asset value, and therefore the gain comes in. We've seen some interesting impact of that, and any other investments. Derivatives I spoke about briefly. Embedded leases I spoke about in that example that I gave you. Debt cost. This is a very interesting area. Do you know, under the old Indian GAAP, a company could raise foreign currency debt, okay, and record zero interest cost on it. I hope you've done it. I hope you know how. And if you don't bother actually, you will change anyway. But in the past, you know, if you had, there was a difference between how you accounted for coupon, which is what you pay to the lender on an annual basis or the bondholder on an annual basis, and redemption premium. If you paid redemption premium, you could charge the redemption premium against your share premium account directly. So you never had a cost on that. And many instruments were structured as zero coupon redemption premium driven instruments. And you never anyway had to worry about foreign currency, because any foreign currency difference anyway you could have capitalized. Now, of course, all of this is not permissible anymore. So we are seeing the impact of that coming through. The debt costs have kind of gone up. Actuarial gains and losses have come in as a positive, because in the past, actuarial gains and losses used to hit your earnings, but going forward, they go to other comprehensive income, which is in reserve, so it doesn't affect EPS. Acquisitions is another area which people are realizing, particularly as they do fresh acquisitions. There is one IT company who I will not name, where earnings were impacted by 20% because of the effect of amortization of intangibles that arose on an acquisition. So these can be very, very significant. Stock options, there is a cost which is coming in. Now, my own personal view, and this you will not see in any kind of written analysis, is that this still does not capture the full impact. And the reason is because we've done a lot of grandfathering. We've done a lot of one-time transition benefits. So let's take acquisitions. Companies who've done multiple acquisitions in the past, but have all done those before 1st April 2015, have not seen any impact in the June 16 quarter, because they have locked into their old accounting. There is no change. But when they make a fresh acquisition, the first time they make a fresh acquisition, that amortization of intangibles is going to come in. Or companies which have taken foreign currency loan and have capitalized the FX losses on those foreign currency loans can continue to do that for the old loans. That's one of the transition things that you will hear about. But when you take a fresh loan, sorry, you are on your own, you have to take that into the P&L. So my own sense is that while the June 2016 numbers do not show a very drastic impact on an overall basis for these 74 companies, that is not necessarily representative of what I expect to see in the next year as some of this becomes more mainstream. So bear that in mind, because you may have some smart aleck telling you that look, India moved to IFRS, IND-AS in 16-17 and nothing happened actually, just 2%, profits just fell by 2%. I think that's a very misleading statement, so I would watch that space. Alright, I have taken away whatever time I had, but if the organizers are okay, I'm happy to take a couple of questions. Yeah, please.
Questions are open on both the sides.
I'm sorry?
Questions are
okay, good, very good. Very good. So any questions, thoughts? Yes, if you could just use the speaker, that would be sorry, if you could use a...
I will be loud now.
Okay, is it okay? Yeah, fine.
One point which you made on me, that was why it should be or other the debate whether it is necessary on companies which are complying with India. And since you are on this ICDS company, most of the ICDS are also taking care for those who are not compliant with India. In case ICDS are to remain, then there is no need for even other company.
I'm sorry, I didn't follow the last bit of your question.
If the ICDS are
Yeah.
compliant to IFRS,
Yeah.
and most of the ICDs, especially after 5, are okay, they are almost compliant with IFRS or IND-AS. Then there is no need for MAT even on those companies.
Oh, actually, that's not true. That's not true. I'll tell you why it's not true. First of all, the ICDSs are not modeled around IND-AS. The ICDSs are modeled on old Indian GAAP. So if you see the revenue standard on ICDS, that is not modeled on the new.
I am saying after 4.
No, after 4. No, after 4 also. There are multiple examples. So, for example, if you see the ICDS on fixed assets, which I assume is after 4, right, is based on old Indian GAAP.
But because of the law, see.
No.
Whichever. So both adjustments are relevant.
No, so first of all, ICDS are not based on IND-AS. ICDS are based on the old Indian GAAP. Point number 1. Point number 2 is, remember, even for companies, assume for a minute they were based on IND-AS, okay? Even in that case, please remember that there will be many companies which are unlisted and which have a net worth below 250 crores, which will continue to follow Indian GAAP for their accounting in the future. And ICDS they will do, even if they have to do it in the tax return for calculation. MAT will be on the book profit. So I think there is a problem to be dealt with out here. That because it's not aligned. I'll tell you how globally this is dealt with. Okay, globally the IFRS standard in the UK, for example, for 10 years from 2005 till this year 2015, the IFRS standards were only applicable to consolidated financial statements. They never applied to standalone. Standalone continued to be a whole UK GAAP, and that is one of the ways. But anyway, that's all water under the bridge. Sorry, you had a question. Can you use the mic, please? I'm a little bit. Thank you.
We have this phase 1 and phase 2. Phase 1 is for the network of more than 500, and phase 2 is for companies having more than 250 crores network or going to issue for the mistake.
Sure.
For other companies, is it mandatory? Is there a timeline or voluntary adoption is permissible? Or?
Yeah, voluntary adoption is permissible, but other than that, there is no timeline. So if, as I said earlier, if you are an unlisted company where the net worth is below 250 crores, then IND-AS will never apply to you. Okay, now having said that, actually one interesting thing is happening. Is Indian GAAP itself will change over time. So this may happen, and therefore my own sense is, other than very few areas where it's very complicated, Indian GAAP itself, the Indian accounting standards, the base standards are followed by those unlisted companies below 250 crores itself will start moving closer and closer. So whichever way you get to it.
So just to add that, actually institute is doing that.
Sure.
What they are doing is that normal Indian accounting standards which are today applicable, they are trying to modify and make it in line with IND-AS to the extent possible.
Correct.
The major, as I think Jamil was saying, the major problem will come in big standards like financial instruments, and there also, so I am in the committee, so I know. So there also what we are trying to do is that we are trying to align principles, major principles as far as possible, and we are coming up with a guidance note. So because we don't want to disturb that accounting standard full framework. So by way of a guidance note, the institute is going to say that you add this. So I think over the period, what is going to happen is that Indian accounting standards that below 250 crores also will be at least 80-90% in line with Indians. That's what is the plan.
Okay, I'll take one last question and then I'll leave it.
I mean, when we started, when you said carve-outs, you gave an option, optional carve-outs. Will the company be able to change them if I've adopted something for this quarter or adopted for this year? Will I be able to go back and say, I wanted to go into the 1, 2, 3 options?
Yeah. So the optional carve-outs are also of two types when you can go into the detail. Some of them are one-time choices, okay, and that's irrevocable. In the sense, if you make that choice, if you decided to make the transition using the fixed asset as Indian GAAP, you can't do too much about it. But on some of the other areas, you do have choices, which you will, in the details you could see that. But most companies I'm working with, I'm actually working with at least 5 companies, very, very large companies, which have given us a mandate to say, just make sure my IFRS profits and my IND-AS profits are the same. Okay, so tell us what we should be doing. Okay, I'm conscious of time, but I wish you the best for the next 5 Saturdays and the rest of the day today. And I'm sure it's going to be a good experience. experience and thank you.
I will agree, Jamil is set a perfect scene for what is going to come for the next 6 Saturdays. I now request Hiral Patel to give a vote of thanks. And after that, sir, we'll just have a quick lighting of the lamp for you. And before we begin the technique.
Yeah, Shri Jamil Bhai, President Bhai, and Rahul, my Chairman of Allied Committee, and distinguished guest, invited guest, participant. It's my privilege to have been asked to propose a hearty vote of thanks on this occasion. A very big thank to Jamil Bhai for enlightening us on the IND-AS current developments, touching upon the regulatory aspects of MAT, ICDS, the impact of various committees, reports and other things. They will definitely help us in understanding the subject more in detail. We'll definitely learn out of this 6 days. On behalf of the entire team of Chamber of Tax Consultants, audience and participants, and on my behalf, extend a hearty vote of thanks. Thank you, sir. May I request everyone
We just do the lighting of the lamp before.
Thank you. All right, thank you. Wish you all the best.